Hello, everybody. This is Toni Turner, and welcome to the Market Now as of Friday, October 4th, about 2 p.m. Eastern. Well, U.S. job growth increased moderately in September, with the unemployment rate dropping to near a 50-year low of 3.5%. That soothed market concerns that the slowing economy is on the brink of a recession amid lingering trade tensions. Still, despite the continued employment growth and sharp drop in the jobless rate, economists expect the Federal Reserve to cut interest rates at least one more time this year, and that could either be the end of this month or in December. And on that note, let's go forth and look at three charts that could give us some insight into the week to come. Excuse me. First of all, as we always do, we're going to look at a daily chart of the S&P 500 spider. SPY is the symbol. This is the exchange-traded fund that closely follows our S&P 500 benchmark index. Now, when I captured this chart today, the SPY was trading at $292.92, just barely below the 50-day moving average, the green line you see coming in here. And that line is coming in at $293.98. And it could, of course, it's known to be able to present resistance to whatever's under it. And right now it's the SPY, but that's not a definite. We'll have to see how strong the SPY is. Of course, we know that back on July 26, the SPY made an all-time closing high at $302.01. That's about 30.20 on the S&P 500 itself. Then it fell from there down to its lows at about 281, fell below the 50-day moving average, and of course this was all on problems with the trade talks. Then it managed to wander sideways all the way through August. Then on positive news about the trade talks, it popped back up again, returned to its all-time highs at about $302, but couldn't close above, couldn't penetrate. There were no buyers out there saying, okay, I'll pay more for the SPY right now, for the S&P 500 stocks, and I'll hold it overnight. So the close is where the commitment comes in, and that did not happen. Since then, the SPY reversed again, came back down in the last couple of weeks, fell below its 50-day moving average, which is something we don't really like to see, fell down to lows here this week of about 288. Yesterday even went below that, but managed to close higher, and of course, as you see, is higher today, again at $292 and change, or about $29.29 on the S&P 500 itself. If anybody here is getting worried about a double top, which certainly could catch your eye here, too early for that. The line for that would be about down here, actually where the 200-day moving average is coming in right now, and that's down at $283.77 at the present moment. But this line here coming in at about what we call it 284. That would be the line that the SPY, and that would be 2840 on the S&P 500 itself. And that would be the line that the SPY, the S&P 500, would have to reverse to test and fall through before a double top would be legal. So in no way right now, at least at present, is the SPY making a double top here. I'm not going to say it won't happen. Later, could it come back down and fall through? Sure, but let's hope not. And so that particular concern, at least at this point in time, is not anything to worry about. We have the RSI here, the 14-day RSI coming in. It bounced almost off the oversold level at 30 and is now back up at almost 46. That's just a little under neutral, so that's actually a good thing. We do see the MACD here coming down to the zero line, and so we'll have to see where that goes. And that usually happens, of course, when price is beneath the 50-day moving average. So we're kind of in a wait-and-see place here. Of course, next week's going to be interesting. And to add to the excitement here, we are heading into the third quarter earnings season. So as if we didn't already have enough on our plate, that will certainly add again to the excitement. So please, as we move into this month of October, which is known to be an ornery month at some times, please do keep your stops in place. Please trade wisely. Remember that cash is a position. When in doubt, get out. There's always going to be room for the 3 best months of the year, typically, seasonally speaking, November, December, January. So, but until then, be careful and keep your stops in place and stay tuned. And we will go on to now. I put up a chart today of the iShares Russell 2000 ETF, the IWM. You and I watch this, or at least I do. I watch it a lot of the time, but I put it up here for you all to see periodically. Now, the iShares Russell 2000 ETF follows the Russell 2000 index, which of course is the small caps in the stock market, companies valued at $300 million to about $2 billion. Small caps are the drama king, the drama queens of the market. They can be very, very rowdy. They're kind of a little manic, actually. When the Russell starts moving higher, nobody can catch up with it. And when it gets cranky and starts moving lower, it also can do that in a very dramatic fashion. So we often, though, watch the Russell 2000 because it can act as a leading indicator for the market. Now, when I captured this chart, the IWM was trading today. As you see here, it's below its 50-day moving average. It's below its 200-day moving average, unlike the SPY and the Qs, which are trading above their 200-day moving average. The IWM has tried to party, but it is very lethargic and just can't seem to keep it together. So right now, the IWM did come down to lows here at about 145 or so yesterday, or I should say on Thursday. Now it's back up to today $148.19. Now we know that the IWM rebounded quickly off December lows that everybody made, but unlike the SPY and the NASDAQ, it did not return to its previous all-time high, which you can't see on this screen. That was 173 in August of 2018. It's never made it back up to that point. The SPY has, the NASDAQ almost has, but the IWM has not. So that's just something to tuck in your pocket and think about, just to keep, maybe add a little bit more caution to what we do. Now, it made an all-time closing high at about 161, not all-time, excuse me, a relative closing high in August. This April about 161, and since then it's been making slightly lower highs, which is a negative, because it means that investors will not buy more than they did before. It's also, as you can see by this channel line below, making slightly lower lows until right now, until Thursday. So at least it stayed even here on Thursday and went down to, again, about 145 on Thursday. So I'm very closely watching these lows here. Again, it did bounce off of those lows. That's a good thing. I'm watching support here at about 145. And as you see, this channel line comes in down here just a bit below 144. So as long as the IWM can stay above this 145, 146 level, I think we're going to be okay, at least a little bit bullish. If the IWM comes down and falls below and closes below this channel line at a little below 144, then I'm definitely going to become a lot more defensive. For sure. But hey, who knows? Maybe earnings season and lower interest rates, if that happens this month, can take the IWM back up. As I said, it tends to be a very dramatic bunch of stocks. So one never knows if it's going to bounce and then jump higher again. We'll have to keep an eye on it. Because it can act as a leading indicator, I am going to watch it very closely in the coming week, because I believe it can give us clues to the future market direction. So stay tuned and maybe keep an eye on the IWM. Our last chart today is one we haven't looked at in a little while anyway. This is the S&P, the SPDR S&P Home Builders ETF, symbol XHB. It has 35 holdings. Some of the top holdings are Lennar, D.R. Horton, Pulte Homes, and Whirlpool. In April, and you can't see, of course, you can't see this on your chart, but I wanted you all to know, as you know, I'm fond of looking at long-term charts because I really want to know where a certain asset has been. That's the way to do it. So I looked at a monthly chart and I saw that in April of 2006, and of course that was a couple of months after the XHB was created by the SPDRs. It hit a high of about $46.50. I wanted to see where its all-time high was, and that's where it was. So that was in April of 2006, and if you were in the market around then, you know that 2007 and 2008 were pretty nasty years. The market fell dramatically and started higher again the first quarter or so of 2009, and so did the XHB. So the XHB, you still can't see in this chart, took off dramatically in 2012 and actually rose to a high of 47, retesting those old highs in January 2018. Now this year, after coming down with everybody else in December, it generally trended higher here, as you can see, staying above its 50-day and 20-day moving averages, finally getting back up over its 200-day moving average, and pretty much, not all the time, but pretty much walking up its 50-day moving average when it started softening up a little bit in April. Fell below it a few times, popped back up, down a few times, popped back up in July, August. That was a rough month for everybody, July and August particularly, and has started moving up again over its 20-day moving average, and now bounced off on Thursday, bounced off of its 50-day moving average. Now, I do believe that the anticipated interest rates should help the home builders ETF even more. Makes perfect sense. People buying homes pay lower interest rates. And of course, that helps the home builders themselves. It helps the suppliers and so forth. Lower interest helps everybody, even though we should kind of look at it as a little bit of a negative in this particular case. We'll take the gift. So today, when I captured this chart, the XHB was trading above its 50-day moving average, certainly above its 200-day moving average. It was trading today at $43.41. It had fallen in the last couple of days, Wednesday, Thursday, and or Tuesday, Wednesday, I should have said, and now is bouncing back up from that 50-day moving average. Now the 50-day is coming in here at $42.10. This is what I'm going to do. If the market remains positive in the coming week, the overall market, I may, and the XHB looks strong, I may add shares of it to my trading portfolio. Now I'm going to place my initial protective stop down here, right down here at $40.70, and that's going to come in just below this bottom trend line here. Do you see this? Right below that. I'm going to give it a little extra room because it's really, really close to the 50-day moving average, but this bottom trend line is important. So I'm going to, again, set my stop at $40.70, and if the XHB then can rise and move up and break above this close by resistance here at 44.50, I may add to my position. So if any of this appeals to you, you may want to watch the XHB in the coming week. And now for our upcoming economic reports, but first, please join us this coming Monday for our next session of Tony's Market Club. If you're not sure how to make money in this market or what to do, let us help. During our session, we talk about which side of the market to trade. I give you a mini trading lesson, and I also give you stocks and sometimes exchange traded funds that may become ripe for high potential trades. Can't attend the live session? Not a problem. The recording is available to all of our members just a few minutes after the session ends. Toni's Market Club is a low-price, high-value opportunity to learn how to trade more successfully and how to make more money. So please join us. For more information, go to the link on this screen or simply click on the orange, I believe it's an orange button below. And now for the upcoming week's economic reports. Not much on Monday. Tuesday we have the Producer Price Index. Wednesday we have crude inventories. Thursday we have the Consumer Price Index, our usual jobless claims and natural gas inventories. And on Friday we have the University of Michigan Consumer Sentiment Report. Again, join us for Toni's Market Club this coming Monday. Don't miss out on this fantastic opportunity to raise your trading skills and particularly your trading profits. Until next week, keep green on your screen. I'm Toni Turner, and this is The Market Now.